Hi, everybody. This is Dan Sheridan at Sheridan Risk Management. Good afternoon. Wednesday, September 4th, a little bit after lunchtime. And as you look at the market here, SPX is 55.20, down about 8 points after a big down move yesterday. It's been a very interesting last month and a half. As you have starting here July 15th, as we go from July 15th to August 5th, it's about 3 weeks, the market went down about 500 points or 10%. And then from basically beginning of August 5th, for the next month or so, basically up 400 to 500 points. Maybe 8% or something like that. And so, and what also stands out to me is so many of these big candles, which represent maybe the range in SPX for the day of 70 points or more, which I've seen more for a month and a half period than I have seen in decades. And so even though you could say net, we really haven't gone anywhere in a month and a half. The reality is if you've traded, it's like, boy, has that been volatile. And in reality, today, on September 4th at 55.24, we're only 140 points or so off the all-time highs in the history of civilization. So what we do is just try to find trades that we're comfortable with for the given market environment. Here we're VIX at 21, which are in the high end of the range, especially if you exclude the last 4 days around that August 5th, where the market went crazy and volatilities shot up. But something I'm looking at today, you could see here, we're kind of, right near the just a basic 20-day moving average is like 55.17. We're right around there. But we're below like the 8-day moving average. So you might say, if you believe the short term, we're a little bit below some of the shorter term moving averages, you might look at a call credit spread, especially if we're up a little bit. But what I'm going to show you a call credit spread, but by tweaking it a little bit, kind of turns it into a range bound trade and you have no risk in one direction, the downside, which I like. You can set this up on the put side if you'd like. So here's the mechanics of it. It would be a skip strike butterfly. So here I'm going SEP 27. So that's about 24 days out today. And I'm buying the 56.90, selling 2 5700s. And I'm buying 157.20. So you can see my short strike, I'm about 180 points above the current price of 55.21 and 55.20 in the SPX. And I'm buying my long strike. Well, here's your credit spread. Your credit spread, we have one credit spread, the 5700, 57.20. That's a 20 wide credit spread. If it was buy one, sell one. And then on top of that, I'm overlaying, take half the width of this, a 10 wide call vertical debit spread, 56.90, 5700. So we're skipping the 57.10. So that's why it's skip strike. So if you want to look at it, basically you're starting out with the 5700, 57.20 call vertical credit spread. And it might say, the deltas are a little too short for me. I like the fact that we have no risk in one direction, but can I reduce my short deltas a little bit? So I overlaid on top of that. I took half the width of this. This is 20 wide. sell another of the 5,700 calls, the same short as the credit spread, and then buy an option 10 points before that. So I have a 20 wide credit spread and a 10 wide vertical debit spread on top of it to turn it into a butterfly, basically reduce my short delta. So here I'm about 1.5 delta short, which on a $5,500 vehicle is pretty close to range bound for me. And this is the SPX. And what's nice about it is, if you look, the capital in this trade is about $830. I'm bringing in a credit of around $180. That's over 20% potential yield. So I have no risk on the downside. I'm not as short deltas as a credit spread on the upside. You know, as we go up, if I want to turn it into an iron condor for free, you say, how do you do that for free? Well, if you add a put credit spread to this, right? Right now, our margin on this trade is 835. If I sell the put credit spread, our margin will go down. That's how it works, because I'm going to add a put credit spread since I already have a credit. So adding a put credit spread, if we go up, would reduce the capital. I'd probably be looking for 10% on this. So if the capital in the trade is $825, I'd be looking for about $80. So if I sold it for $1.70 credit, buy it back for 90 cents debit. So that's something, and especially in a volatile environment, if I can reduce the risk in one direction and get the deltas under control, to me, it's a trade I can live with in a volatile market. Now, if you feel, you know, the next 50 or 100 points are up in the market, you could do this on the put side very similarly. And so I like to go out about 3 weeks on these things. And that's how I set it up. If you have any questions, I'm Dan at Sheridan riskmanagement.com. Check out our site, Sheridan Risk Management. If you'd like to get our 2.5 hours of live content every day, plus all our on-demand courses, live courses, it's a very cheap, $194 a month, and you could stop anytime you want, but great price. Check us out, and we'll talk to you later. Thank you.